We're going to begin talking about how we purchase merchandise under the perpetual system. Now, obviously we may have some inventory to begin with, but if we don't, the first thing we're going to have to do is buy something. So in this example here, we have purchased merchandise inventory, which is an asset. Remember, when assets go up, that's a debit. We used cash. We have less cash. When cash goes down, which is an asset, that would be a credit entry. So in this case, we used $500 in cash and we bought some merchandise. Now, in this case, or the case I just talked about, we were using cash, but quite often companies don't want to do that. They don't want to tie up their cash if they don't have to. So they would rather use, buy it on account, use credit. Now, meanwhile, you've got somebody who's selling the inventory who would really like the cash. Now, quite often sellers will give you maybe a 30-day payment term, but they'd really like your money sooner. So if they can get your money sooner, maybe it's worth it to give you a little bit of a discount to do that. So often what a seller will do is say, okay, you can have 30 days to pay, but if you pay early, I'm going to give you a little bit of a discount. And so here is an example of, and if you are working in accounting or any sort of accounts payable at your jobs, this would be a great opportunity for you to pull out an invoice and see if you see something that looks like this on an invoice. And this tells the person who is paying the bills what the payment terms are going to be. And this is referred to, you'll hear people say 210 net 30, and that's what this means. The first number is the discount. So the 2 is the percentage point. So they're going to get a 2% discount if they pay in 10 days. So that's the 10. If they don't pay in 10 days, then the net, in other words, the whole amount, is due by day 30. So 210 net 30, you could see 215 net 30, 115 net 60. Who knows? I mean, it's really all about the payment terms that the company ends up with. But this format will be the same regardless of what those terms are. So you just have to know what each of these numbers means in this little formula here. And here is an example of an invoice where you would see those terms here on number 5, which is the credit terms 210 net 30. I won't go over the rest of this because I think it's pretty self-explanatory, but here's our inventory for $500. And when we pay that in the 10 days, we're going to only end up actually, where's my mouse, paying $490. So right off the bat, we've added potentially to our profit by paying this bill a little early. And this is what it will look like from our end when we make that entry. So when we first bought the stuff on credit, forget about the original example because that was a cash deal. So now we're going to make the same purchase, this time on credit. Our terms are 210 net 30. So merchandise inventory goes up, debit for 500. Now this time, because it's on account, the credit goes to accounts payable. We, of course, want to take advantage of this 2% discount. So by the 12th of the month, we have decided we're going to pay this so that we can take the advantage of that discount. And that means that we're only going to be sending them cash of $490. But if we just left it that way, we would be out of balance. So what we need to do is indicate that we're going to credit merchandise inventory to show that the actual value of the merchandise inventory isn't the $500 that we entered on the last slide, but is really $490. and then, but we're still going to reduce the accounts payable by debiting it for $500. So we clear off the entire accounts payable because we will have satisfied that obligation. If we look at it from a T account standpoint, this is what we see. We see our initial entry on November 2nd right here. So we've got our accounts payable of 500, our merchandise inventory of 500, and then lo and behold, here comes the 12th where we're going to pay it. We need to wipe out the balance because we're not going to owe any money even though we haven't paid them the full 500. And then we're going to credit the merchandise inventory. This makes the balance in our merchandise inventory $490. And then we're going to pay them the $490 that we owe them. Now, what happens if we pay them after the discount period? Maybe things are a little tight around the 12th of the month. We don't have that money. Well, the answer is we pay them just as if this whole discount arrangement had never occurred, and it's a debit to accounts payable and a credit to cash for the full 500. Now, what if we buy something and we get it back to our factory and maybe it's not quite right, or it's a little damaged, or wasn't exactly what we ordered? And I'm sure you've all had that. There's a couple of ways that that can be dealt with. The first way is we call the people back that we bought it from and said, hey, what you sent me isn't the right thing. And they say, well, if you keep it, we'll just adjust the price and for the inconvenience, and you'll just keep the item and we'll take a little bit off your bill. Or you can say, no way, totally not what I want, don't need it, don't want it, and I'm bringing it back. And so that would be the case of a purchase return. The first is an allowance, so it would be a reduction in what was owed. The second is we're just giving them the item back. So in this case, there's some defective goods and they've taken a little bit off our bill as a result of the defective goods. So we're going to assume that the original purchase was entered, and then we get back and discover, hey, there's a problem and we need a credit. And I don't want to use that word because it has a whole different meaning in this world. But anyway, so we're going to reduce the merchandise inventory by $30, which is the amount of the allowance that we're going to receive as a result of this defective merchandise. And then we're going to reduce the accounts payable. Now, we haven't paid anybody yet. We're just going to reduce the amount on our books that we owe as a result of this defective item. And I'm going to try and move my image over here. All right. So now we've got Z-Mart purchasing $250 of merchandise on June 1 with terms 210 net 60. On June 3rd, Z-Mart returns $50 of the goods before they pay the invoice, and then when Z-Mart pays on June 11th, it's going to take the 2%, but it's only going to take it on the $200 balance after the items were returned. In other words, they're not going to get a 2% credit on, or discount on merchandise that they didn't keep. So these are what those entries will look like. We've got our original purchase, which is just like, every other purchase on account. And then we've got the items that we returned here of $50. So it's going to reduce our merchandise inventory as well as our accounts payable. And then we've got the discount that we're going to take. So, and because we've returned 50 of the original 250, we only owe them 200. 2% of 200 is going to be $4. And we're going to credit that back to merchandise inventory. They're going to get their $196, and we're going to wipe out the balance on the accounts payable by entering a debit. Oftentimes, these items need to be shipped. And how we will deal with the shipping costs and the inventory and all of that depends on the terms of the shipping. So there are two terms that you want to be on the lookout for. The first is FOB shipping point. The second, FOB destination. And there are really two issues associated with these. The first is who owns the goods, and the second is who's responsible for paying the cost of the shipping. So for FOB shipping point, meaning the point at which the item is shipped from, if basically the seller, their responsibility for this item ends at their loading dock at their back door. When it goes out the back door and onto the truck, the seller has no part of it anymore. The buyer is paying for the transportation cost and the buyer owns it. So if the buyer is having their inventory taken and they happen to have goods that are in transit on their way that were FOB shipping point, the buyer's got to make sure that they're counting those goods that are still on the delivery truck, even though they haven't shown up in the warehouse. So because the buyer is going to be responsible for the transportation costs, the buyer is going to include the transportation costs as part of the cost of the merchandise inventory. So when they pay the transportation costs, it's going to be a debit to the merchandise inventory and a credit to cash. The other term, and making sure that you get these separated flashcards, do whatever you need to do, because these concepts will come up over and over. FOB destination. And this means that the person or the company that's selling the item is responsible for the items and the shipping costs for them until they reach their destination, until they reach the buyer's door. So from the seller's perspective, if they're taking inventory and they've got goods that are being sold, even though they haven't arrived at the buyer, or because they haven't arrived at the buyer's door yet, that seller still better count those items in their inventory until they receive notification that they have arrived at the buyer's, and then they become property of the buyer at that point. The seller will be covering the cost of the transportation expense in the FOB destination example. And they're going to make the journal entry differently. It's not going to be part of the merchandise inventory. It's still going to be cash. We're still going to use cash to pay the shipping company. But in this case, it's going to be a delivery expense. Where's my mouse? A delivery expense, not a cost that's added into our merchandise. And here are the journal entries that, or here's an example for FOB shipping point with a transportation cost of $75. So this is where the buyer is going to record that in their books. So in terms of the cost of purchases, what we're going to, this is a breakdown of what this is going to look like. We've got our invoiced cost minus our discounts received, minus anything we sent back, plus any costs that it cost us to have the item shipped to us. And then the bottom line number here is going to be the net cost of merchandise purchases. I'm going to stop here and go on to the next video for to continue with the perpetual system.